Chapter 1. Jonathan's Introduction to Investing. Jonathan had always been a saver. Growing up, his parents taught him the importance of putting money aside for a rainy day, and he took that lesson to heart. But as Jonathan entered his 30s, he started to wonder if there was more he could do with his savings. He'd heard about investing, but it seemed complicated, and he wasn't sure where to start. One day, while chatting with his friend Mark, Jonathan asked, "What exactly is investing, and why should I do it?" Mark, who had been investing for years, smiled and said, "Investing is about making your money work for you. Instead of just letting it sit in a savings account, you put it into things that can grow over time, like stocks, bonds, or real estate. It's a way to build wealth and achieve your financial goals, whether that's buying a home, starting a business, or retiring comfortably." Jonathan was intrigued. He had always thought that investing was only for the wealthy or financial experts, but Mark assured him that anyone could start, even with a small amount of money. Over the next few weeks, Jonathan did some research. He learned that investing could help him outpace inflation, meaning his money would retain its purchasing power over time. He also discovered the power of compounding, how even small investments could grow significantly if given enough time. The more he learned, the more excited he became about the possibilities. But there were also doubts. Jonathan had heard stories of people losing money in the stock market, and he wasn't sure if he was ready to take that kind of risk. Mark explained that all investments come with risk, but with the right knowledge and strategy, Jonathan could manage that risk and make informed decisions. Jonathan realized that investing wasn't as scary as he thought. It was about understanding the risks, setting clear goals, and making informed choices. And so, with a mix of excitement and caution, Jonathan decided to take the first steps on his investment journey. Chapter 2. Exploring different types of investments. Jonathan's first step was to understand the different types of investments. He knew he needed to educate himself before diving in, so he turned to books, online courses, and, of course, his friend Mark. One evening, over a cup of coffee, Jonathan asked Mark to explain stocks. "Stocks," Mark began, "are shares of ownership in a company. When you buy a stock, you own a small piece of that company. If the company does well, the value of your stock can go up, and you can make money. But if the company struggles, the value can go down." Mark explained that there are two main types of stocks: common and preferred. Common stocks give you voting rights and the potential to receive dividends, payments made to shareholders from a company's profits. Preferred stocks, on the other hand, usually offer fixed dividends, but don't come with voting rights. Jonathan learned about growth stocks, companies expected to grow faster than the market average. These stocks might not pay dividends because the companies reinvest their profits to fuel further growth. Jonathan liked the idea of being part of a company's growth story, but he also understood that with higher potential returns came higher risk. Next, Mark introduced Jonathan to bonds. Bonds were different from stocks. When Jonathan bought a bond, he wasn't buying ownership in a company. Instead, he was lending money to that company or a government entity. In return, they promised to pay him interest over time and repay the loan when the bond matured. Bonds are generally safer than stocks, Mark explained, but they also offer lower returns. They're like the steady, reliable option in your investment toolkit. Jonathan also learned about mutual funds and ETFs, which pooled money from many investors to create a diversified portfolio. Mutual funds were managed by professionals, which sounded reassuring to Jonathan, but they often came with higher fees. ETFs, on the other hand, were similar but traded on stock exchanges like individual stocks and usually had lower fees. Real estate was another option Jonathan considered. He knew people who had made good money buying and selling properties or renting them out. But he wasn't sure he was ready to become a landlord. Mark suggested looking into REITs, real estate investment trusts, which allowed him to invest in real estate without actually owning physical property. By the end of their conversation, Jonathan felt like he had a good grasp of the basics. He knew that each type of investment had its own risks and rewards, and he was starting to think about which ones might be right for him. Chapter 3. Understanding Risk and Return. As Jonathan continued his journey into the world of investing, he knew that understanding risk and return was crucial. One weekend, he sat down with a notebook, ready to figure out where he stood. First, he thought about his risk tolerance, how much risk he was willing to take. Jonathan realized that he wasn't the type to chase after quick profits. He preferred a balanced approach, one that offered growth but didn't keep him up at night worrying about market swings. He also considered his financial goals. Jonathan was saving for retirement, but he also wanted to buy a house in the next 5 years. These goals helped him decide how much risk he could afford to take. He knew that the closer he got to his goal, the less risk he should take, especially with money he might need soon. To manage his risk, Jonathan learned about diversification. This strategy involves spreading his investments across different asset classes: stocks, bonds, real estate, and perhaps even commodities. The idea was that if one investment didn't perform well, others might balance it out, reducing his overall risk. Jonathan also discovered the importance of asset allocation. He decided to divide his investments between stocks, which offered higher returns but more volatility, and bonds, which were safer but offered lower returns. This mix would change as he got older or as his goals evolved. One strategy that particularly resonated with Jonathan was dollar cost averaging. By investing a fixed amount of money regularly, no matter what the market was doing, he could avoid the temptation to time the market, something even seasoned investors found challenging. As Jonathan jotted down his thoughts, he felt more confident. He knew that investing involved risks, but by understanding those risks and taking steps to manage them, he could make smarter decisions. He was ready to start building his investment portfolio. Chapter 4. Building Jonathan's investment portfolio. With a clearer understanding of risk and return, Jonathan was ready to build his investment portfolio. He began by setting his financial goals more concretely. For Jonathan, the goals were straightforward. He wanted to save enough for a comfortable retirement, buy a home within 5 years, and maybe take a dream vacation or two along the way. These goals gave him a timeline and helped him decide how much risk he could take with each part of his portfolio. Next came asset allocation. Jonathan decided that for his retirement savings, he could afford to be more aggressive since he had several decades before he'd need the money. He allocated a significant portion of his retirement portfolio to stocks, with a smaller percentage in bonds for stability. For his shorter-term goals, like buying a house, Jonathan chose a more conservative approach. He leaned heavily on bonds and kept some money in cash, or cash equivalents, like money market funds, to ensure the funds would be there when he needed them. With his portfolio set, Jonathan knew that portfolio management was key to staying on track. He committed to rebalancing his portfolio every year, ensuring that it stayed aligned with his goals and risk tolerance. If his stocks performed well and grew faster than his bonds, he'd sell some stocks and buy more bonds to maintain his desired allocation. He also decided to use dollar cost averaging for his retirement investments. By contributing to his retirement account every month, he could smooth out the effects of market volatility, buying more shares when prices were low and fewer when they were high. Jonathan's portfolio was now in place, and he felt a sense of accomplishment. He knew that investing wasn't a one-time event, but an ongoing process. But with a solid plan and the discipline to stick to it, he was confident that he could achieve his financial goals. Chapter 5. Jonathan explores investment strategies. With his portfolio built, Jonathan started to explore different investment strategies to optimize his returns. He was eager to learn more about how he could grow his wealth and make the most of his investments. The first strategy he looked into was value investing. Jonathan liked the idea of finding undervalued stocks, companies that were strong, but whose stock prices didn't yet reflect their true potential. He started analyzing financial statements and earnings reports, looking for companies with solid fundamentals that the market seemed to be overlooking. Buy low, sell high, he reminded himself. But he also knew that value investing required patience. Sometimes it could take years for a stock's true value to be recognized by the market. But Jonathan was okay with that. He was in it for the long haul. Next, he explored growth investing. This strategy focused on companies expected to grow faster than the market average. Jonathan was drawn to the idea of investing in innovative companies, particularly in tech and healthcare, where he saw potential for significant growth. These companies might not pay dividends, but their stocks could increase in value as the companies expanded. Jonathan also learned about income investing. This approach appealed to him for its promise of steady, reliable returns through dividends interest, or rental income. He liked the idea of building a portfolio that could eventually provide him with regular income, especially as he got closer to retirement. Jonathan even dabbled in socially responsible investing, SRI. He wanted to ensure that his money was supporting companies that aligned with his values, businesses that were committed to environmental sustainability, social justice, and ethical governance. As Jonathan tried out different strategies, he realized that he didn't have to choose just one. Instead, he could blend these approaches to create a diversified portfolio that reflected his goals, risk tolerance, and personal values. By doing so, he felt he could maximize his returns while staying true to his principles. Chapter 6. The importance of research and due diligence. As Jonathan delved deeper into investing, he realized the importance of doing his own research and performing due diligence. He knew that making informed decisions was critical to his success as an investor. One day while browsing the news, Jonathan came across a hot stock tip. It was tempting to jump in, but he remembered Mark's advice: always do your research. He spent the evening reading up on the company, analyzing its financial health, and looking at its past performance. He even checked out the broader industry trends to see if the company was well-positioned for future growth. After careful consideration, Jonathan decided not to invest. The company's fundamentals didn't seem as strong as the tipsters had claimed, and there were too many red flags for his comfort. He was glad he took the time to investigate instead of rushing in based on hype. Jonathan also learned to scrutinize investment products like mutual funds and ETFs. He looked beyond the marketing materials and focused on key metrics like expense ratios, management styles, and historical performance. He realized that some funds might not perform as well as others in the long term, even if they were popular at the moment. When it came to real estate, Jonathan didn't just rely on online listings. He visited properties, talked to local real estate agents, and researched the neighborhoods. He wanted to make sure he was making sound investments, whether he was buying a property outright or investing in a REIT. Jonathan knew that staying informed was crucial, so he made a habit of reading financial news, following market trends, and continuing his education through books and courses. He also connected with other investors, learning from their experiences and insights. Through his research and due diligence, Jonathan built a solid foundation of knowledge that helped him make better investment decisions. He felt more confident in his abilities as an investor, knowing that he was equipped to navigate the complexities of the financial markets. Chapter 7. Jonathan's journey with long-term investing. As time went on, Jonathan became more committed to the principles of long-term investing. He understood that building wealth wasn't about quick wins, but about steady, consistent growth over time. He often reminded himself of the power of compounding, the idea that his investments could generate earnings, and those earnings could then generate their own earnings, fascinated him. Jonathan made sure to reinvest his dividends and interest, letting his portfolio grow on its own. One of the biggest challenges Jonathan faced was the temptation to react to short-term market fluctuations. There were days when the market dipped, and he felt a pang of anxiety, but he remembered the advice he had read: stay the course. Jonathan also worked on managing his emotions. He learned to avoid making decisions based on fear or greed. Instead, he focused on his long-term goals and trusted his investment strategy. By sticking to his plan, he avoided the pitfalls of emotional investing. Diversification remained a key part of Jonathan's strategy. He knew that having a mix of assets helped reduce risk. Even if one investment didn't perform well, others in his portfolio might balance it out. This approach gave him peace of mind and allowed him to sleep soundly at night, knowing he wasn't overly exposed to any single risk. Another important lesson Jonathan learned was the need to adjust his strategy as needed. He stayed informed about changes in the market and the economy, and wasn't afraid to tweak his portfolio if necessary. Whether it was shifting more assets into bonds as he approached retirement or exploring new investment opportunities, Jonathan remained flexible and adaptive. Jonathan's commitment to long-term investing paid off. Over the years, he saw his portfolio grow steadily, and he felt secure knowing that he was on track to achieve his financial goals. His journey taught him that patience, discipline, and a focus on the future were the keys to successful investing. Chapter 8. Common mistakes. Jonathan's investment journey wasn't without its challenges, but he managed to avoid some common mistakes that trip up even experienced investors. One of the first lessons he learned was to avoid emotional investing. Early on, Jonathan had been tempted to sell during a market downturn, but he resisted the urge. He realized that making decisions based on fear or greed could lead to poor outcomes. Instead, he stuck to his plan and focused on his long-term goals, even when the market was volatile. Another mistake Jonathan avoided was chasing hot tips. He remembered how easy it was to get caught up in the excitement of a sure thing. But instead of following the crowd, Jonathan always did his own research. He knew that not all tips were reliable and that it was better to make decisions based on solid analysis rather than rumors. Jonathan also paid close attention to fees and costs. He knew that investment fees could eat into his returns over time, so he carefully chose low-cost options when possible. He kept an eye on trading fees, expense ratios, and any hidden costs associated with his investments. By minimizing these expenses, he was able to boost his overall returns. Jonathan's discipline and commitment to learning helped him navigate the complex world of investing without falling into common traps. He was proud of how far he had come and knew that avoiding these mistakes would help him achieve his financial goals. Chapter 9. Jonathan's Future Planning. As Jonathan's investment journey continued, he started to focus more on planning for the future. He knew that investing was a long-term endeavor, and he wanted to ensure he was prepared for whatever life might bring. One of Jonathan's top priorities was retirement planning. He wanted to make sure he had enough saved to enjoy his golden years without financial stress. He took advantage of retirement accounts like his 401k and IRA, appreciating the tax advantages they offered. Jonathan also began to think about withdrawal strategies to maximize his income and minimize taxes once he retired. Another important aspect of Jonathan's future planning was estate planning. He realized that it was important to have a plan in place for how his assets would be distributed after his death. Jonathan updated his beneficiary designations, created a will, and even considered setting up a trust to protect his assets and reduce potential estate taxes. Jonathan also understood the importance of continuing education. He knew that the world of investing was always changing, so he committed to staying informed. He read books, took courses, and networked with other investors to learn about new trends, strategies, and opportunities. By planning for the future, Jonathan felt confident that he was setting himself up for success. He knew that his careful preparation would pay off in the long run, allowing him to achieve his financial goals and provide for his loved ones. Chapter 10. Jonathan's Reflections and Conclusion. As Jonathan looked back on his investment journey, he felt a sense of pride and accomplishment. He had started with little knowledge and some trepidation, but through learning, patience, and careful planning, he had built a solid foundation for his financial future. Jonathan knew that investing was a journey, not a destination. It required ongoing attention, a willingness to adapt, and the discipline to stay the course. But he also knew that the rewards were well worth the effort. In the end, Jonathan's story wasn't just about numbers or financial returns. It was about growth, learning, and taking control of his future. He had transformed from a cautious saver into a confident investor, ready to face whatever challenges and opportunities lay ahead. And so, as Jonathan continued on his path, he remained committed to the principles that had guided him so far: understanding the risks, setting clear goals, staying informed, and always planning for the future. With these tools, Jonathan was confident that he could achieve his financial dreams and help others do the same.